Aloha, I'm Elena Hugh. Welcome to another edition of PTC TV, brought to you by PTC'14 Platinum sponsor, Equinix. This is the last of 5 programs specially created for PTC'14. Mahalo for joining us.
Aloha, I'm Sharon Nakama. Thank you for joining us on PTC.org for the final installment of PTC TV for PTC'14. Please enjoy the video of our Wednesday keynote sessions and our awards luncheon. Mahalo for tuning into PTC TV this year, and I look forward to seeing you again next year at PTC'15. Aloha.
Mobile traffic has had some interesting impacts to the mobile ecosystem. First and foremost would be mobile network operators. For the longest time, mobile networks tended to be a single application network, and that was voice. This is very similar to the behavior we saw 14 years ago when public ISPs came together in our facilities in order to peer and localize the exchange of traffic with one another in order to make sure that the internet delivered a positive experience. We're now seeing the same thing from the mobile network operators. There's some interesting secondary effects to other members of the mobile ecosystem for very similar reasons. A good example would be social media platforms and advertising platforms that tend to co-locate next to one another in order to serve content as efficiently and quickly as possible. Another good example would be handset OEMs, who will tend to proxy things such as email and other types of popular content in order to make sure the end user has a positive experience.
PTC'14 is made possible in part by the generosity of the PTC'14 sponsors. Mahalo to PTC'14 Diamond sponsor, Tata Communications. Thank you for all of your support.
Weekdays are for rising to the challenge. They're the days to take care of business, when possibilities become reality. With CenturyLink as your trusted partner, our visionary cloud infrastructure and global broadband network free you to focus on what matters. With custom communication solutions and responsive, dedicated support, we constantly evolve to meet your needs every day of the week. CenturyLink, your link to what's next.
Time now for the day's first keynote as Stefan Beckert explores the role of carriers in the new world.
Our first presenter is Stefan Beckert. Stefan is the VP of Strategy for Telegeography. He spent the last 15 years in the telecommunications arena focused on market research and consulting practices. Prior to Telegeography, he was the director of the wireless data services for the Strategist Group. He's coming on stage today to share his insights and discuss trends related to how the proliferation of mobile devices and the demand for increased mobile broadband has impacted the international traffic. In addition to his professional obligations and involvement in the telecommunications marketplace, he's a very involved member of the PTC. He's a member of our Board of Governors, and he's also the co-chair for the program, which has put together the great speakers we've had this entire week. Please join me in welcoming Stefan to the stage.
Thank you, Faye. It's a pleasure to be here. Thank you for being here. I know it's always challenging on Wednesday when you're kind of glazed over and dealing with the after effects of the Tapa and CoreSite and Orange and everyone else's parties. When I was asked to speak at PTC this year, I couldn't really say no to Sharon, but also had to spend some time trying to think about how to relate our data to the theme of more fun of the new world, and well, to the theme of the new world. And I thought it would be fun to take a look at compare the world that was many years ago in telecom and compare it with the world we inhabit today and look at how things have changed. Turning first to the world of voice, then I'll move on to the world of internet backbones, and finally conclude with a look at trends in the international networks business. Back in the days of yore, in 1903, AT&T's financial report demonstrated that voice was at one point pretty much the best business in the world. To contradict John Rockefeller, who said the best run business in the world is an oil company, he probably had never looked at AT&T's financial results. In 1903, they had 65% net margins, and they paid out 80% of those margins as dividends. And we're growing 25% annually. It stayed a good business for a long time, actually, after that. In the 1978, the year, if I recall correctly, of the first PTC, AT&T reported in their financial results that international voice grew 27%, and thanks to AT&T's frugality, investment in technology, they were able to only keep price increases down to just under 4% annually. Those days are obviously gone. These days, I think it's fair to say the voice business has matured in the 110 years since AT&T's 1903 report. The U.S. began liberalizing its international voice market in the 1980s, and in the 1990s, markets around the world followed suit. And that resulted in very sharp price declines in markets in Europe, in North America, and then moving on to Asia. And that resulted, as you can see, in that sharp spike in traffic growth in the late 1990s and early 2000s. But as you move along the axis further to the right to 2013, you'll also see that growth rates are not what they used to be. Price declines that used to be could be offset by the volume growth, but in more recent years, as traffic growth has dropped into the single digits, it's become ever tighter and ever more difficult to maintain revenues. Some of the factors that are driving the declining growth rate of voice are pretty self-evident. I mean, most obviously, I think, is simply the fact that there are diminishing returns to price cuts. If you're cutting the price of international calling from $1 a minute to 50 cents a minute and then 10 cents a minute, you're going to see significant increases in demand and in volume. It may not offset the price declines, but it's certainly going to boost volume growth. But when you move from 2 cents a minute to 1.8 cents a minute, you're not going to get necessarily the same kind of customer response. The other factor that really has driven growth over the decades is the spread of mobile phones to emerging markets. As people in emerging markets got telephones, their relatives abroad, their migrant workers were able to call home. But at this point, virtually anybody who wants a phone has a phone, and the marginal effect of each incremental phone being added now on international traffic is pretty small. Of course, there's also these guys. Knowing this audience, just show of hands, I'm curious, how many of you have more than 2 of these applications on your phone right now? 3? 4? How many of you recognize all the logos? These are all OTT companies that have, in the past couple of months, reached at least the 100 million download mark on the Google App Store. And obviously, that massively understates the user bases of many of these companies. And Google is not the only source for those applications. But it does give you a sense that they're certainly among the most widely used OTT applications. WeChat, I believe, has somewhere in order of 300 million users at present. And just one of these companies, Skype, by our estimates, had about 214 million minutes of on-net cross-border traffic in 2013. An increase of about 36% from the previous year, which comes to 54 billion minutes volume increase in just 12 months. And in 2013, Skype's international traffic alone grew 50% more than the volume of all of the phone companies in the world combined. So the volume being moved by these guys is enormous. Even if they're not yet at the scale of Skype, collectively, they're going to have an impact. And that's been reflected in growth trends. This figure shows something of a what-if scenario. The line you probably recognize as the growth rate of international voice traffic, and the top line is what would happen to international traffic growth, international voice traffic growth, if Skype's traffic gains were added to increases in international long-distance volume. And as you can see, if you add Skype's traffic to the traffic of the phone companies, growth trends are much more in line with those historical trends that we've been seeing. Now, I'm not suggesting that Skype is to blame for all of the decline in voice traffic growth. I'm not trying to point fingers at anyone, and Skype certainly wishes phone companies no harm, since they make the vast majority of their money off of traffic terminated at the PSTN. But it's hard not to conclude that, given those enormous volumes, that some of that is coming at the expense of phone companies and has certainly been affecting growth rates. Now, the PSTN is not going to go away anytime soon. The biggest OTT application out there right now, Facebook has, when I last checked, about 1.2 billion users globally. The PSTN has about 8 billion endpoints and keeps adding a few hundred million per year. So right now, there's no other network out there with the potential reach of the PSTN that could serve as a replacement for the PSTN. So I don't think anybody needs to lose sleep about it disappearing from one day to the next. But conditions in the market are going to keep getting more challenging. And as the international voice market is changing, we're also going to increasingly see divergences in carriers' strategies. When a rising tide stops lifting all boats, it may be time to switch to some other mode of transportation. You can see here some companies like Tata are orientating themselves towards growth, going for volume gains. Others, like Verizon, have chosen to start making a bit of a retreat from the voice market, only focusing on the routes where they feel they can make the margins they get, and deliberately allowing volumes to decline. And I think over the coming years, we'll increasingly see different carriers pursuing different strategies to figure out how to stay relevant in the voice market and how to maintain their margins, or perhaps to diversify or divest the voice business and move into other lines. Turning now to the internet. What you see here is the internet backbone in 1991. NSFNet had a nationwide T1 network, which even in 1991, it turns out, was a bit constrained. Within 1 year, NSFNet had been upgraded to a T3 network, a 30-fold increase between 1991 and 1992. Now, that's kind of overstating their growth rate because the T1 network had actually been deployed in '88. But even so, that's about 210% compounded growth. These days, we're no longer in the days of 210% compounded growth. Looking at international internet traffic growth rates, there was only one large regional market where traffic growth exceeded 41% in 2013. And 41% isn't necessarily a magic number, but it is the growth rate at which traffic doubles every 2 years. There were, of course, some sub-regional markets, the Middle East, Africa, Central Asia, Eastern Europe, where we did continue to see growth rates above the 41% level. But overall, growth rates have gradually been declining into the range of about 33% annually in recent years. So what's causing growth to slow? The primary driver of the slowdown is, in fact, video. Video is the primary driver of traffic growth globally, and as the internet becomes our replacement for the TV. But video traffic is also extremely cacheable, and video traffic has increasingly been moving to direct download sites, to streaming sites, and to other more legitimate means of acquisition. And as traffic has moved from P2P to those direct download and streaming sites, ever more of that content can be cached or distributed by CDN. So an ever smaller share of that traffic touches the backbone network. And that's why we're seeing these slowing traffic growth rates, because the primary driver of traffic growth doesn't necessarily need to cross the core network. It just hits the access network. Now, even so, it's important to keep in mind that the growth rates we're seeing are over 30% annually. And I think it's also important to keep in mind that the volumes are enormously larger than they were at one point. To go back to the earlier map I showed you, the Atlanta to Georgia link, the Atlanta to Washington, D.C. link on this map that in 1992 had 45 megabits per second of capacity, last year had about 1.9 terabits per second of capacity. So between 1992 and 2013, it grew 43,000-fold. And with those very large numbers, of course, it's hard to chalk up the same kinds of volume gains. Now, unlike the days of yore, telcos these days are not as readily able to raise their prices, not even just 4% annually. This figure tracks the price per meg of IP transit in 5 major markets around the world, and the percentage shows the rate of decline of IP transit prices in those markets. You can see, obviously, in the US and New York, in the US and in Europe, in major markets, IP transit these days is well under $1 a meg for larger volumes. But it's not necessarily cheap in other markets around the world. There's still wide divergences in prices. Singapore is about 5 times higher than North America and Europe. Rio about 12 times higher, and in Kuala Lumpur, the price of IP transit is about 18 times higher. And if you look at the growth rates, you'll see they range from, well, the decline in prices, they're ranging from about 20% to about 30% in all of those markets. So prices are not converging. Those differences are persisting over time. And those price differences actually create an incentive for large content providers and larger ISPs to route traffic to other countries, for example, from Kuala Lumpur to Singapore to purchase upstream transit. And that in turn continues to drive demand for cable and network capacity. Turning now to the world of international networks. This is a map of the Eastern Telegraph's network in 1901. I love old network route maps. It's remarkable how much they actually parallel today's maps. But there is one difference. These days, most of the world is wired. It may not be as wired as people would like it to be, but by our estimates, and take them with a grain of salt, it can be hard to document everything exactly. By our estimates, there are at this point only 19 countries left in the world that aren't connected by some sort of cross-border fiber link, be it terrestrial or submarine. And those 19 countries have a combined population of less than 10 million. So if you're in the business of building greenfield subcable networks, Antarctica is the next big opportunity. Penguins need bandwidth. Now, that doesn't mean there's no subcable construction going on. There's still construction going on, but it's focused primarily on adding redundancy, supplier diversity, and to add route diversity as well, to reduce prices and to improve network resiliency. But there are very few networks these days that are going to be the first network landing in a given country. Submarine cable capacity in the past decade has grown enormously, from about 8 terabits per second on the routes shown here to 70 terabits per second in 2012. And we're currently updating our numbers for 2013. But that comes to about 25% compounded annually, and I expect we'll see comparable growth rates in the coming year. Most of that capacity increase has not come from new cable construction, though. It's come from increases in capacity on existing systems, by upgrades to existing systems, by lighting additional fiber, and by transitioning to higher bit rates. Between 2008 and 2012, on the routes shown here, carriers added about 30 terabits per second of new capacity. About 80% of that capacity came from upgrades to existing fiber. Even on the Trans-Pacific route, where the Unity, TPE, and AAG cables were deployed during those 4 years, about 70% of the gains in capacity came from upgrades to cables rather than from new cable deployments. And even though operators have been adding capacity, have been lighting additional capacity on their networks, it seems unlikely they're going to run out at any point soon. There was a period when you had to add, during the old days of the TAT cables, for example, as the cable ran out of capacity, you had to lay a new cable. And every 2 to 3 years, there'd be an announcement of TAT5, TAT6, as cables started filling up and as they had to start planning for the next new system. On the transatlantic route, though, at this point, we've added, during the past 7 years, 2005 to 2012, operators have added over 13 terabits per second of new lit capacity on the transatlantic route. But during that same time period, even though no new cables have been deployed, potential capacity on that route has fallen, the ratio of lit capacity to potential capacity has fallen from 24% to 14%. And I should add the estimates you see here of the ratio of lit to potential capacity on most of these routes just reflect 40 gigabit per second line rates. As more cables, particularly in the Trans-Pacific, are upgraded to 100 gigs, or as the engineering studies are conducted to figure out what kind of capacity they can handle at 100 gigs, we're going to see those ratios of lit to potential capacity probably continue to decline. We expect it to decline on most major routes in the current year. So essentially, we have, there's no limit to how much capacity a cable can handle. Now, the rising lit capacity on fibers, on networks, and the increasing utilization rates on those cables are reducing the cost per megabit per second of capacity on those networks. As these costs come down, service providers, given the competitive nature of the market, are passing on those cost reductions in form of price declines. And if you look at the growth rate, this figure here again tracks prices on half a dozen major intercontinental routes and one U.S. domestic route. And it also tracks the rate of price decline over the past 3 years. And you'll notice, not entirely coincidentally, that there are wide-ranging differences in cost of circuits around the world. And similarly, that the rates of price decline are pretty comparable to what we're seeing in IP transit price declines. And I don't think that's any great surprise, because the primary cost component of IP transit service, of course, is the cost of long-haul fiber, of the long-haul capacity needed to transport that traffic. So we're seeing these cost reductions coming, prices coming down around the world of lit capacity, and that in turn is bringing down IP transit prices. And that's really helping to enable the spread of OTT applications, bandwidth-intensive applications, and making it possible to continue providing affordable internet service to consumers. One interesting aspect also is that this figure here just tracks the rate of price declines of 10 gigabit per second wavelengths. And while the prices of individual bandwidth types of specific services, be it 10 gigabit wavelengths, 40 gig wavelengths, are declining at 20% or more annually, we need to keep in mind also that buyers are transitioning from smaller circuits to ever larger circuits. And the cost per megabit per second of a large circuit, of course, is significantly lower than that of a small circuit. So if you look at sort of the longer run trends and the implications for service providers, in the early 2000s, the common bandwidth products used in the intra-Asian routes were STEM1s. These days, it's all 10 gigabit per second wavelengths. The cost per megabit per second of a 10 gig wavelength at this point is about 2% that of the cost per meg of a STEM1 in 23. Given those enormous price declines, revenue growth is challenging. We're projecting tremendous increases in bandwidth requirements over the next decade, but we're projecting only a 3% increase in revenue, because prices are going to keep coming down, and carriers, the big buyers of circuits, are going to keep transitioning to ever higher bit rates, bringing down the price per megabit per second of capacity purchased. But the good news, of course, is that there's no lack of demand for your products, and the other good news being 3% growth is better than many in the industry might have hoped for. With that, I'd like to thank you for your time, and wanted to remind you also that the new world is scary. Remember to bring a map, but also remember that maps keep changing. and that our concept and understanding of the world is also going to keep changing, and that geography keeps changing. Thanks very much for your time.
A very special mahalo to the 2014 PTC Board of Governors for their year-round leadership and support. PTC'14 is made possible in part by the generosity of the PTC'14 sponsors. Mahalo to each of the PTC'14 Platinum sponsors. Thank you for all of your support.
When we connect the dots, it's not just a line that we draw. It's your information that is shared. It's your business that gathers stride. It's your dreams that take wings. It's your hope to connect with a better future. It's your satisfaction of connecting with your loved ones. It's the joy of discovering new things. The joy of connecting with new people. It's the pleasure of bringing together people and smiles. Because when you connect with an organization that offers you unparalleled diversity, flexibility, reach, and scale, to offer you an unmatched experience, collaborate with the organization that is recognized as partner of choice for its stronghold in the emerging markets. That enables you to achieve success at every level. You don't connect the dots. You connect with the world.
Maribel Lopez, principal and founder of Lopez Research, discusses analytics, big data, and mobility for right-time experiences.
Morning, everyone. It's my pleasure now to welcome Maribel Lopez, who I'm going to be doing a fireside chat with. And Maribel, we're going to spend a lot of time going through your bio here. You are the co-founder of the Mobile Research Council, founder of Lopez Research, ex-Forrester analyst, Forbes columnist, expert on all things mobile. What did I miss? Is that like a pretty good summary?
I think that's it.
Okay, good. So
you miss world hunger and peace and all that other stuff. That
okay,
I do in my free time.
Founder World Hunger. Or you didn't found World Hunger, sorry.
You can use a little more founder world hunger here, but that's a different issue.
So let's see, one thing we didn't mention, which is probably a good way to start, is the fact that you're the author of the upcoming book from John Wiley & Sons called Right Time Experiences. Catchy title, what the heck does that actually mean?
Okay. I'll probably just do a little bit of history. So I'm an industry analyst, and as an industry analyst, I started wondering about the future of mobile. When I started wondering about the future of mobile, I thought that it would be contextual services. So we talked a lot to people about contextual services, and it wasn't a new concept. Other people were talking about it as well, but I found that people didn't really understand context. There was no 30-second elevator pitch, right? So you get in an elevator, and they're like, well, what does that mean? And you've got to say, well, when this happens, when that happens. So eventually I said, well, everybody understands the concept of getting the right service or the right information when they need it. And so then I said, maybe this is just what we'll call it right time experiences. And the thing that is interesting as I started thinking about right time experiences, I discovered it's about more than mobile. It's actually about the intersection of the technology trends we've been building for the past 5-10 years. So cloud computing, social networking, mobile, big data, and analytics, how they all come together and how they transition business. And so right time experiences is just giving people the right information or service at the point of need. B2C, business to employee, business to partner. So not just a consumer-oriented concept.
So I hear everything you said about contextualization and right time experiences and everything, but what, like, just for me, like right now, what would that mean? Like how could I, or somebody in the audience, what would be an example?
Yeah, so I'm going to the airport soon, right? Right time experience for me might look something like Google Now is telling me, you have to leave right now because there's a traffic jam on Hawaii 1, right? And you're not going to make your flight. It's a result of understanding, so context is multiple things. And I think in our industry, we frequently think of context as just location-based services. It's location, it's time, it's things you've done in the past. So it's basically trying to give you what you need. If you're walking into a store, it might say, hey, Joe, nice to see you again. The jeans that you bought last week are on sale. If you are a service provider doing wholesale, it might be understanding that your customer is experiencing a radical spike in bandwidth and needs more bandwidth turned on immediately as a result of that. And given the type of traffic, it needs a certain quality of service. So it's moving us into this concept of smarter services that react to the conditions around them in real time or near real time.
So it's sort of predictive, anticipatory, behavioral, and real time. Cool. And
I just wanted to mention, we're going to be doing the live sift. So if you want to ask any questions, live sift.
I'm supposed to say that.
Okay.
We're going to be doing the live sift. So if you have any questions, we'll do it via live sift. Thank you.
And the password is?
The password is PTC'14. That's the event code, technically speaking.
There you go.
So that sounds interesting. What is that? We're mostly service providers here in the audience. What exactly are the implications of this concept for service providers?
Yeah. So I think in some ways we've been talking about this move to smarter services for a while, and so that in and of itself isn't anything new. I think what is new about it is thinking about how do we break down our internal silos so that we have access to all of our existing data so we can do better customer care, better provisioning. The second thing that I think is interesting about it is that talking about how we use big data and analytics now to deliver services. So what kinds of information do we have and how do we monetize that information is another aspect of it that is new. And connecting in a more meaningful way to third parties. One of the things that's happened in the past is we've had a lot of siloed services from everyone. So, the over-the-top service provider will give you something, you get bandwidth from somebody, you get a voice app from somebody else, you get a fitness app from somebody else. So it's thinking as service providers, what can you pull together as partnerships, as API frameworks, embedding yourself into other networks and services. So we talked about APIs for a while. Does anybody remember I think it was Telco 2.0, they did the two-sided business model? Remember that? Mm-hmm. Right. So I think it's more of a three-sided business model. If you could have three sides, I'm not sure that's technically accurate, right? So one of those is you're going direct. One of those is you're going through partners, and a third is you're trying to figure out how to monetize the data that you get from the services that you're delivering in aggregate, if not necessarily directly to an end customer. So I think that's one of the big changes that we have now is we have the tools to do that. We still have privacy regulation issues. I understand that. However, I'd say that a lot of the over-the-top providers have proven that you can push the envelope on privacy pretty far if you deliver relevancy. So I think our goal is how do we deliver services that are relevant, and that's a combination of what we provide and a combination of working with partners.
Yeah, it could be scary, right? Like kind of all of a sudden a service predicts something for you, like you're about to die or something that, or whatever,
God,
you're going to get hit by a truck, or you, by the way, you should live your life differently. Are privacy concerns significant in like the whole concept? Or maybe a even better question would be, what's different now about like right time experiences and the whole concept of contextualization in real time and personalization and predictive analytics and all of that versus, I don't know, a year ago, 5 years ago, whenever?
Yeah, and that's a great question because, like I said, the concept of context isn't new, right? People's sharing is newer, and that's been something that's been happening for the past 3 to 5 years. Our ability to process this data and information in a more real-time fashion is really, we've been since 2007 talking about big data and Hadoop and analytics, and I think we're now just getting scalable products in that sector. We're starting to get to the point where you could do cloud-based offerings of those services, so I think that makes it more accessible to a lot of people. The Internet of Things is, we had machine-to-machine communications before this, right? And I think the only difference between machine-to-machine communications and IoT is we've started talking about broader landscapes of people, right? So now it's fitness devices, it's it's pills you can swallow, it's your car, so we are talking a lot more about connected devices. However, I will say as part of that three-sided odd business model that we were talking about, I think IoT is great. I think it's very challenging for service providers, right? And I think the challenge for service providers in IoT is to actually do some of the more mundane things first where people will pay you money. So we're getting very excited about the business to consumer aspect, which has all these privacy concerns about what do you do with health data or what do you do with their GPS driving log data. And maybe, the real money is in something like, well, how do I make people's HVAC systems, their heating and cooling run better? How do I help them track assets within the organization better? So some of the more classic machine-to-machine stuff we talked about, but now people are actually ready to do it and they'll start to pay you for it. And those are right-time experiences because you are giving people certain piece of information at the point of need. You're giving them predictive intelligence. You're selling, GE sells uptime now as opposed to jet engines, right? And I think that's a really interesting shift in concept of selling a hardware product to selling an availability service, which sounds an awful lot like what telecom providers do, right?
All right, we're going to do some tweet-length answers here because I personally myself came up with some really good questions after reading them on the screen.
Okay.
So here's a pretty cool one. How do we wrap bioinformatics and embeddable technology into the real-time augmented experience?
So how do we wrap bioinformatics and technology?
So all the stuff around
real-time?
like pacemakers that are generating info on heartbeat and things like that, nanobots in the bloodstream and.
Yeah. Okay, so there's two challenges to that question. One is technically, what do you do about the flow of data, right? So I think we have some of the unstructured database style collection tools that can help you actually get in the data, flatten it and process it. We're talking about complex event processing if you want to do it in real time, right? But we're starting to see there's folks like Guavis and some of the stuff at IBM where you can start to do some of that processing of that in real time. And then the third aspect of that is how do you make it meaningful for the end customer, right? And the meaningful for the end customer part is usually the biggest issue. Are you going to build a platform that aggregates a lot of that data so that they can have a better health picture of themselves so it's not just the heart rate? Are you going to work with healthcare companies for them to deliver that as part of their portfolio? And I think the answer to both of those questions is yes, you probably have to approach it from both angles. And the one with the better interface, which is probably the market-driven one, will win. But you want to be able to show people things, give them an option to have you be the front-end service, and then if they want to embed or white label what you're doing into their own service, that should be an option as well.
So I'm going to actually sort of put two questions together, one of which was, what role does infrastructure play in providing an experiential or contextual information ecology? And then sort of the related one has to do with carriers. So it's what are the relevant right-time services for carriers, given that everyone except carriers are ahead of the C, which I assume is ahead of the curve?
Okay. So I actually think infrastructure plays a critical role, and it's a role that people don't think about a lot, right? So you need infrastructure for all of this to happen, but you actually need a certain kind of infrastructure. So we started out with a pretty generic structure that was basically around it being available and getting connected. Then I think the second iteration of that was it being able to be, say, on demand, right? I think the third iteration of that, which is where we're trying to progress to now, is that it is smarter. So it starts to be more predictive about what our customers are going to need in terms of capacity, in terms of quality of service. So building in that type of intelligence. So not only can they have it on demand, but you'll be able to predict that certain things are probably going to be asked for at certain times, and they're going to need certain types of quality of service associated with them. So I think we do elements of that, but I don't think we're all the way to a lot of smart services provisioning in real time for a lot of our customers. I also think that part of that infrastructure is security infrastructure. Almost every enterprise customer I talk to is struggling with, how do I secure and manage the data, and how do I make sure that my services don't go down? And there's a lot of intelligence that service providers have about what traffic patterns look like, and if something bad might be happening to my customer soon as a result of surges in traffic or abnormal traffic and issues that they have. So I think providing them the smarter QoS-based infrastructure, but also with security in it, that might not be purchased as a separate security service the way we do it today. We have to figure out how much security we can build in as part of the smarter services infrastructure.
I have no idea how much time we have left, but we'll just take the whole morning if need be.
We have no monitors down here, by the way.
So there's, what about privacy, especially with bioinformatics? And then the one I'll display relates to that, which is basically, do you think that the adoption of this kind of approach will slow down with the data breaches? In fact, I heard that the one company that hasn't had a data breach was identified recently. So
well, there you go.
It's keeping anonymous so that it's not targeted.
Got it. Okay, so there are at least two elements of privacy. There's the classic opt-in, which I think we're all aware of in mobile in general, right? There's a second aspect of that, which I think is around regulation. And I think regulation is going to be very different in different countries. So I don't know how to answer the regulation question. We talk about this a lot in the US with HIPAA and what you can and can't do and what you can and can't do with IoT and things that are that could inhibit right-time experiences, such as you need to have government approval before you can do software updates on certain types of devices, right? So I think part of getting to this vision of right-time experiences is for us to be working with the regulators over what's possible for us to do that makes the process more secure, that makes it run better. So we're going to need to be able to do certain things like automatically push updates to certain types of technologies, like wristbands or things that might be ingestible or things of that nature. So in terms of getting people to buy in, to opt into this thing, I think it gets back to what are they getting out of it, and who do they trust with their data and how sensitive that data is. And there are degrees of sensitivity around that data. If you're going to share high cholesterol data with a drug company, I might not be interested in that. But if you're just going to keep the data and I can use it to be part of my online medical record for me to take with me wherever I go and be in control of my own data, I think that's important. One of the things that we have to realize now that as individuals, we don't have a lot of control over our data and services, right? They're not very portable. And if I have something on Fitbit, Fitbit keeps it, right? And maybe they've decided to share it with 2 or 3 partners, right? So what can service providers do in this landscape that empowers the individual to feel that they're in control of their data and they can put it where they want and have it accessed the way they want? And then, what will they allow you to do with it? So I think the first thing is just tell them, it's just here, we won't do anything with it, we'll keep it safe for you. And then you can start to layer on services around that once you get more critical masses of data. Okay,
well, speaking of right time experiences, now is the right time to experience leaving the stage. So we'll do that, and thank you very much.
That was fast. All right.
Are you plugged into social media? Then join the conversation online. Follow PT Council on Twitter and use the PTC'14 hashtag, which is #PTC'14. You can also like Pacific Telecommunications Council on Facebook. PTC'14 is made possible in part by the generosity of the PTC'14 sponsors. Mahalo to each of the PTC'14 Gold sponsors. Thank you for all of your support.
The world has never ceased changing. People will never stop dreaming. In a practical, effective, and innovative manner, at a speed surpassing the future, China Telecom will set up more and more milestones in the history of telecom industry. Connecting the world, China Telecom.
Infinera's approach to the subsea space is to bring you the industry's best and most powerful innovations, help drive your ability to generate revenue and lower costs to create a competitive advantage, and to deliver to you a subsea network that's designed for optimum performance for your customers. Don't just take it from us, take it from our customers, from around the world that have trusted in us and continue to grow their network with the best subsea network upgrade in the business.
Now we'll hear a keynote panel about capital markets and investments.
So welcome, thanks for joining. So I'm John Atkin, I'm with RBC Capital Markets. I work in the San Francisco office, and I'm pleased to be joined by Tim Horan from Oppenheimer, Bob Morse from Stratum Capital, and Brandon Amber from Palladium. And what I'd like to do is maybe start off with Tim and work down the line. We can have a brief self-introduction and tell us kind of what areas of telecom you're focused on and what parts of the capital structure you're focused on.
Thanks, Jonathan. I'm a stock analyst. I don't know if a lot of people know how Wall Street works, but I provide research and kind of tell people what stocks to buy and sell. So more on the agency side of things. I think my co-panelists here are more on the principal side where they actually are doing a lot more of the investment. I've been following communications for 20 years. The last 4 or 5 years has kind of morphed into a lot more cloud as we kind of see the industry kind of clearly converging and driving all the growth in the industry. I follow a fairly broad range. My thesis has been for over a dozen years that we're moving to what we've called cloud computing for a dozen years. And the industry, we think, is going to get a lot more horizontally segmented. We think the applications have been getting separated from the underlying networks, and a lot of that's been kind of proving out, but we think that's going to remain a trend for the next decade. The number one point I wanted to make, and I came here, I'm not sure if any of you are looking to kind of access to public markets or raise capital, but the markets right now are very, very strong and very open, and this is kind of one of the top 3 or 4 periods I've seen in my kind of 20 years here.
My name is Bob Morse. Am I on?
No.
Oh.
You should be on now.
Yeah, there you go.
How are we doing now? Still not? Why don't you give an intro and then we'll get
Okay. Let me jump in there. My name is Brandon Amber, based in Hong Kong as a head of Palladium Partners that focuses on advisory and development across telecom media technology. I've been in Hong Kong and focused on Asia for 8+ years. Areas that I've been focusing on has been a lot more on the infrastructure side of telecom, along with telco towers, data centers, underwater cable, domestic fiber, along with spectrum assets across from the 700 to 2.5 gigahertz bands for looking at 3G and 4G spectrum, and at different times, more developed markets to emerging markets cases. So I've worked with a few of the private equity and currently is an advisor to Apollo Global Management out of New York, and helping them look at opportunities in the buyout space across Asia.
All right, let's try this again. How are we doing?
Perfect.
All right. I just paid my conference registration fee, so. I am CEO of Stratum Capital. Stratum is a newly formed private equity firm focused on core enterprise IT and services. My background is about 20 years in the private capital markets, doing private equity investing, primarily in the U.S. and primarily around enterprise IT, although that's included a lot of communications businesses, particularly in the data center, fiber, and managed services spaces. Businesses you might know include Savvis Communications, Telecity in Europe, and private businesses today in the U.S. like BioWest and Intermedia. I think I'm here to help provide a perspective on what's happening in the private markets, in particular the technology side of what's happening in the cloud, and with a particular focus on the U.S. and to a lesser extent Europe.
Great. So I think we've heard the word cloud mentioned twice, but maybe kind of bring it up a level. And starting with Tim, you cover a broad range of different subsectors within telecom, carriers, infrastructure providers of various stripes. And tell us, from the standpoint of your clients, how do they look at these different models, and what type of investor is looking at some of these big companies like AT&T and Verizon? Who are the folks that are maybe preferring data center cloud providers, and maybe there's hybrid models out there as well?
Well, I would say, I think investors are kind of confused right now, and a lot of Wall Street's in flux because things are changing, so rapidly. A lot of the legacy carriers are not growing all that much. And so there's quite a bit of bifurcation. We have companies that are kind of growing very low single digits, not growing at all, kind of traded 1-2 times revenues. And we have a whole bunch of other companies that are kind of growing at 20+%, and they trade at like 7, 8, 10 times revenues. But a lot of what's happening is the industry is getting very bifurcated with companies that provide either the basic infrastructure like towers or fiber or data centers, and a lot of them are becoming more REIT focused, and they're looking to provide more stable dividends over time. And then you do have AT&T and Verizon, which I think are perceived to be more stable dividend-paying stocks. They're a little bit more wireless focused. And then we have the high-growth names. They would be companies like, more recently, RingCentral came public. They provide voice over IP to small businesses and are growing, extremely rapidly. But you got very, very different investor bases in them. REITs are fairly dedicated. You have more income funds, AT&T and Verizon, and then you have really more growth funds where I think a lot of hedge funds have been very focused on growth, and then you have a lot of, you do have some mutual funds that are more specialized in growth that invest in those names also.
Tech on the fly.
So, if anyone can hear me. So Brandon, you've spent some time, I think 8 years plus in the Asia Pac region, and maybe compare, for the audience, both within the region and compared to North America and other parts. Where are we in terms of adoption of cloud, adoption of outsourced models like towers?
Yeah, I would say in a lot of cases with the future evolution, the cloud and managed services and the comfort of having somebody else manage and secure your data is definitely much more advanced in certain cases in the United States. You see AWS starting to make an inroads. We were just Tim led a panel with even showing about KVH and their kind of growth in certain of the what I call the tier 1 cities of Tokyo, Hong Kong, Singapore, and even Sydney. But the future of cloud and data center growth will be into China, along with potentially Manila, Bangkok, Jakarta, and even into India, where companies like an NTT Communications made an acquisition in the India market. Equinix has expanded their reach into Asia Tone to buy more capacity in Hong Kong and into China, along with 21 Vianet's growth in China itself. But when it comes to the SMEs and the enterprises, it's still a little bit getting a comfort level and security level to be able to have a third-party provider being able to host all their information and getting used to that level and the cost structure. Pricing has to be changed at a little bit different case than the way it's done in North America or even in Europe. But I think that is coming, and that's really what the next 5 to 10 years of growth in the cloud services will be in the Asia region, because today's SME will be tomorrow's large corporation potentially, and especially based out of Asia, but then going international and getting footprints in Europe and in the Americas.
So mixed trends in the adoption rates of domestic SMEs to adopt outsourcing, and yet a lot of investment taking place by U.S. headquartered companies and multinationals. Yeah. So as they make those investments, are they focused on meeting the needs of other multinationals with Asia Pac operations, or where are they in terms of trying to penetrate the domestic?
I think the easiest for some of the players, it's a case-by-case basis in the way, or country by country. It's multi-billion people across Asia, but each market is so different, and you really have to, even if you're a multinational coming into Asia, there's not as many third-party providers that can give you a full blanket coverage and saying, okay, now I have offices across 7 different cities, 6 different countries, whatever. There's not many providers that can do that. There's still, maybe the IBMs or the Fujitsus or the HPs, and there's certain places where they need a provider in market to market. I think there's going to be a little bit more of a consolidation or getting more feet on the ground to build a kind of a turnkey solution and say, okay, I can help you across multiple markets from day one, and that's where it's going. From the multinational, but from then the local SME, they're needing services in their market, and as they grow and say, okay, now I'm going to go outside my home country and say, I'm an Indian company or an Indonesian company, and I want to get into Singapore, I want to get maybe long-term into a London or Europe, or even to California, so something close to San Jose. That's where it's going in that side of things.
So, Bob, you've had board positions with operators that have European bases, that have U.S. bases. You've spent a lot of time looking at Asian opportunities. How do you kind of size up different countries within Asia in terms of data center, cloud adoption, and how ripe are they for private investments?
Sure. I'll echo a point that was made earlier. Even if the U.S. is a little bit further ahead in adoption, it is still at a very early level. Over 80% of the compute cycles are still on-prem with people, and those things that aren't done in-house, most have just been sort of moved out into a data center. So I think despite the fact that we're seeing large volumes of investment, we are still at a relatively early stage of adoption. The second thing I'll say is as we see markets like this evolve and grow, we see a lot of customer segmentation and specialization. And I think that we're going to see that with very different markets catering to international businesses who want a safe hub and may have concerns about data security or network access, which will be driving factors for them more than price in terms of where they're going to hub in Asia. And then you see operators with very different approaches who are catering to either the local market, an India for India business, or serving carrier needs or other things. And so I don't think we'll see a one-size-fits-all there. We haven't in the U.S., and I think as the market continues to grow, we will continue to see this sort of fragmentation and increasing number of providers who are focused on different specialized niches.
So I'd like to ask the audience to chime in with any questions if there are any. And just to kind of briefly follow on that point, 21 Vianet in China would be a good example. You know, I think 98%, 99% of their business is domestic Chinese hosters and SMEs, and yet you've got some pretty high-profile investments by Equinix and others in that market that are catering to the 1%, which is other Western-based multinationals that happen to have operations in the region. So briefly, any questions?
No questions.
So maybe to come back on a point that Tim made, you know, some of these big companies like AT&T and Verizon, there's so many different moving parts. There's fixed line, there's mobile, there's video initiatives, there's copper-based businesses that are declining. How do they view their strategic services, so that would be data centers, cloud? How fast are the growth rates that they're seeing? Are they big enough? Are these growth rates fast enough to offset the declines that they're seeing in some of their older businesses?
Well, we've seen Verizon buy out the Vodafone stake, so something like 70% of their revenues now are really wireless, and wireless for them is kind of growing in the 4 to 5% range. Verizon bought Terramark, and I think it's been a little bit of a challenge to figure out what the right strategy is going forward. I think that business has grown a little bit slower than what they would have expected. But I think all the carriers are struggling with what do we do with cloud here. Terramark has built up their own kind of protocols and standards to enter the cloud market, for example. AT&T is looking to use OpenStack, and you have, I think CenturyLink is struggling. They bought a company, Savvis, kind of what the right way to go is. I think Amazon is creating a lot of disruption in the industry, and they're trying to figure out how do they respond to that, how do they really take advantage of that. There is, I think there's been some recent net neutrality rules. I'm not sure in the United States where the audience is of that, but I do think AT&T and Verizon would like to use their network and leverage it a little bit more to maybe have a higher quality product or be able to kind of charge more for that network and give themselves a little bit of an advantage and try to attack the cloud that way. But they're still pretty much up in the air. I personally think they need to kind of wake up a little bit and maybe work together a little more closely. They've all been kind of working at odds. I do think the whole kind of coordination or intercloud that people are talking about, makes a huge amount of sense for the carriers. But right now, their longer-term strategy is frankly not really clear to me. So
CenturyLink bought Savvis. I think the Savvis brand name is going away as of yesterday's announcement. Is there anything to read into that in terms of are they now done with the integration, or are they moving in a different direction?
I think they're probably their public comments. They want to move a little bit more into managed services, but it seems unlikely they're going to be able to get the scale on doing a public cloud on their own. I think it remains to be seen. I think you might look for them to maybe white label some of the other public clouds that are out there, or figure out some niches that they can compete in. But I personally think a lot of this stuff is still up in the air. If I was them, I would look. Basically, what I was saying is to look to kind of coordinate, to work together a lot more closely, and frankly, try to be a cloud on top of a cloud, be almost like a middleman for the cloud. But we're not really hearing a lot of comments out of the companies on where they're heading, to be honest with you.
Yeah, and the cable companies as well are facing pressures in their core video business, and so they're looking at the broadband pipe as a way to monetize over the top. Some of them have bought cloud companies or made cloud investments. On the topic of large companies, though, I'm interested in Brandon, in maybe your view, and Bob, if you have a perspective as well. You've got NTT, you've got Singtel. On the systems integrator side, you have Fujitsu that have kind of presence across the region in many of these lines of business. How do you see them making either further investments in markets that they already operate in, or in new markets? And is there a opportunity on the private side to kind of draft behind them?
Yeah. I would say on more of the cloud or fixed line side, it would be NTT under their NTT communications side of the business. Not really their NTT Docomo, their wireless side has been making big investments, or really trying to expand their reach. Singtel has definitely been more on wireless. They've driven a lot of their revenue across ownership stakes that they were able to make in the last 10 to 15 years across Asia, which generates a lot more of their revenue today than domestically, which is Bharti, Globe in the Philippines, AS in Thailand in the past. So all of these markets have been able to generate the revenue to be able to reinvest that into what is the next phase of their growth for them. When it comes to the kind of private investment, they're on the large scale guys, the KKRs, the TPGs, Bains, the Apollos, along with the growing amount of dry powder capital that a Pacific Alliance Group, a Hong Kong-based fund, or an MBK out of Korea, there hasn't been maybe the big enough opportunities to go after. The most recently was Leighton Telecom out of Australia. And that was owned by Leighton Group, which is a construction company that took it over. After they built it, they ended up buying it because the original providers of that service went under. That had domestic fiber. It has data centers in Australia, and they're now trying to build a cable from Singapore to Perth with a landing station in Indonesia. That's through an auction process was bought by Ontario Teachers Pension Plan, which was one of their first directs. This is more of in a way, similar to a sovereign wealth, or kind of usually they invest in big private equities, but they're trying to make inroads, and you're seeing Canadian Pension do the same thing. So you have a more competitive dynamic, and a lot of money that's sitting on the sideline trying to invest, but not having enough of the kind of chunkier deals that they like to put in 100 to 500 million of equity across fiber. You see it in the satellite space, to kind of go off a little bit out of the cloud. There was an auction process for Optus satellite, which is owned by Singtel in Australia, but that was a kind of a failed auction process because of a disconnect on valuation. So that's the other side of the equation that still goes on. If it's carve-outs for large groups that are trying to maybe unloved or underutilized assets, which private equity loves to go after, or auction processes, there's still a valuation disconnect because of where the debt markets are today and how cheap capital is. So bankers are saying, hey, we can put X times multiple on leverage. That means this, an EBITDA kind of number. This thing's worth 10 times, but the real value private equity is looking to pay might be 7, 8, and looking for that uplift, but not willing to pay, the high price of what people think or, the market goes. So you'll see a lot of potential opportunities this year in satellite, in potentially in underwater cable. You've seen people look at Reliance Globalcom in the past. You've seen PACnet, data centers, potentially opportunities. So, and then going outside of that, even DTH, direct-to-home satellite. But right now it's kind of a valuation disconnect, and you're going to have competitive markets like an NTT or Singtel or even Bharti or Reliance out of India try to also maneuver themselves into these transactions.
We see, I mean, I'm going to echo Tim's comment, which is it is an incredibly positive time for new investment at the moment. There is, the public markets are trading at very high values for these businesses that have high growth. The capital markets, the debt capital markets are wide open, and people remain quite constructive on U.S. credit, and so the lending markets are quite open. And the private equity industry has been raising capital again at an increased rate. The total private equity industry has got $2 trillion of assets under management, of which only about half is invested. So there's $1 trillion of dry powder around the world now for all industries. On the private capital, so on the large company side in the U.S., the company that I hear on the tip of the tongue with the CEOs that I talk to more than any other is Amazon. Amazon Web Services seems to really be scaring people with its claims of low pricing and broad platform. I think that bears further study, and in fact, I'm going to sing John's praises for a moment. He recently put a piece out on pricing across the cloud, which reads more like investigative journalism than research analysis. But I think one of the points there is pricing is still evolving very rapidly, and so people aren't exactly sure what they're getting in terms of value for money, even though it sounds like it is supposed to be clear. It is a lot less clear. On the private side, we see also a lot of money flowing into the smaller businesses. The private equity industry accounted for about 20 to 25% of the total transaction volume in the technology M&A market in the U.S. over the last several years. And the reason for that in this segment is that as the mindset shifts and people go from I'm going to run it myself to selectively I'm going to outsource it, it is giving rise to a huge class of people who are writing the software, building the hardware, hiring the people. And they need capital. And many of these businesses are not big enough to access the public markets. They can't borrow the money. And so there really is a role for private equity to play in this market at the moment.
So are there more opportunities that you're seeing in single country investments, or does this require more of a pan-Asian approach to build the kind of scale, particularly that you, Brandon, mentioned, given the checks that are being written sometimes, unless it's one of the larger economies, these businesses probably don't need that much. So how do you see that playing out?
Yeah, no, I think it's businesses that, that are more regional or growing regional, but it's where their kind of home country is. It restricts on foreign ownership rulings. Give you an example, the Indonesian wireless telco market, you can be, I think it's a 65% foreign ownership, but if you wanted to buy an independent tower company, there is no foreign ownership of independent towers. So if you're a wireless telco and you own towers, that's fine. But to carve that out into a separate entity and have a tower company with, third-party base stations, no, that's not allowed in Indonesia. So those type of rules and regulations, similar to the Indian market, used to be 49% foreign. They pushed it to 74%. But the government has really restricted investment, and you've seen a lot less investors look at India over the last few years because the government really did a lot of mistakes with previous 2G auctions that pulled licenses from foreign owners and have destroyed that market for the next few years, and it's finally starting to come back. A lot of investors invested into tower operators and the wireless space. They're still stuck in that investment, and it's getting a little bit harder. So Asia has a little bit more headwinds with regards to country-by-country regulations and different timings of currency and fluctuation of domestic economics that make it a little bit harder for certain investors to go in certain markets. And they kind of still try to, focus on more the developed rule of law where they feel comfortable investing and trying to get out. So it does hurt some players or some markets to get the private equity in to be able to become a large player globally because of their own government restrictions.
I totally agree. The dream of a pan-Asian player, and there are a few people who are making inroads on that, is very, very attractive. Where I've spent the most time is in the data center and hosting spaces, and those tend to be actually quite local markets. One of the trends I heard about at this conference is the fact that the amount of intra-data center local delivery is an ever-increasing portion of the total. And so we find it in practice to be a lot more local market than the theory might suggest.
So audience, last chance for questions if there are any. So, Brandon, you brought up an interesting point. There's differing levels of broadband adoption within the region for both fixed line as well as wireless. 4G is one of the rare areas where the U.S., I think, is ahead of most regions. But where are we in terms of the certainty of licensing for auctions for deployment of 4G? And so maybe you can kind of give us a quick tour across the region as to where.
The closest markets that are the most developed with the United States is definitely, you'd say, Japan, Korea. So even in Japan, all three operators are doing LTE in different bands. And you see SoftBank having a TD and an FDD type of spectrum plan for LTE. One in their TD space, they'll play with an old Wilcom, which is the name, now it's called Wireless City Planning. They have over 2.5 million subscribers on a TD network, a TD LTE network across the Japan market. And you'll see what they, with that expertise, they'll bring it to Clearwire here in the United States and switching that over from WiMAX to TD LTE in the coming months. So that leveraged them to be able to do that. There are, markets like in India. India, the only one that has a pan-Asian TD LTE market is Reliance Jio, which there's two parts of Reliance. There's Reliance Communications, which is Anil Ambani, and the Reliance Industries, which is Mukesh Ambani. He had originally, through their brother partnership, decided to split the telecom business, but now he's coming back into telco with a 2.3 gigahertz, but a TD LTE on a pan-Indian context. So a lot of these guys have gotten into 3G pretty late. And now with some of the TD spectrums that were initially given to WiMAX players are kind of jumping into an LTE more data service. You're right, some of the cities have fiber in the metro rings, but outside of that and where the connectivity is going to go for internet is smartphones, tablets, lightweight devices, and it will be over wireless. And you're seeing that case from a very developed market to a developing market, that they're going to be try to catch up and close that gap over the next couple of years in spectrum and type of services to the marketplace, especially because the handsets have priced down. Smartphones, you used to be trying to get smartphones to $150, now trying to target $50 smartphones in these developing markets. That makes it more reasonable to get onto the web.
So I'm going to let Tim have the last word, and Brandon touched on some interesting points about device subsidies, and many believe that in the U.S. they have gone away because of the actions of T-Mobile. And then you also brought up the issue of standards. When you have large economies like China, India, and Japan supporting a different flavor of 4G, it paves the way for a company like Sprint in this country to then introduce that and gain some volume efficiencies and perhaps overtake, let us know if you think this is true, but maybe overtake Verizon in terms of capacity and throughput. And then further along on the data center side, you've got OpenIX, which is a new initiative in the States to try to open up the environment for peering in each metro area in a market where perhaps a Telex or a CoreSite or an Equinix dominates it. OpenIX has the potential to make peering broader spread across the metro. So a lot to fit in, but any kind of comments on what we just touched on?
Well, broadly speaking, I think we're in about the second inning of the infrastructure that's going to be required for cloud. To your point, Sprint is going to open up a wide breadth of spectrum, and there's a lot more spectrum actually getting auctioned off in the United States. Actually, I calculate almost potentially a 40% increase in the spectrum that's out there in the next kind of 18 months to 2 years. Sprint and T-Mobile have unlimited data, so plans that are out there, we're going to see extremely strong volume growth. I think the networks have to be upgraded to enable a lot of what Amazon is doing for computing, basically real-time, kind of a perfectly scalable bandwidth out there on the fiber side. On handsets, I've been a big proponent. Android-based handsets are plummeting in price. That's going to enter the United States the next 2 years. It's very positive for T-Mobile, the way they kind of sell their services. I think positive for Sprint. For AT&T and Verizon, their model has been to really subsidize really high-end handsets. I think that model's in place for another year or two. but it's kind of hard to see how that's going to be sustainable, and particularly how to me, the Apple-based kind of $650 prices are going to be sustainable with Android, if Android phones are hitting $50, which they will.
They are, because even the local manufacturers in India and Indonesia are, getting into the market. It's not just Chinese handset manufacturers. So
interesting.
That is the growth.
Great. I think we have to call it. Our time is up, but appreciate the panelists participating here.
Thank you very much.
PTC'14 is made possible in part by the generosity of the PTC'14 sponsors. Mahalo to each of the PTC'14 silver sponsors. Thank you for all of your support.
At Shaw Business, we listen to our wholesale partners. From investing in our technology to extending our network's reach, we're committed to providing everything you need to meet the demands of an increasingly connected world. With industry-leading transport speeds and a dedicated customer service team to support your business, we offer the services you need to be successful. Shaw Business, providing reliable network solutions so your customers won't miss a thing.
Trident is a $400 million fibre optic communication system linking Perth in Western Australia through the Northwest Shelf to Jakarta and onto Singapore, facilitating voice, business traffic and internet connection into Australia, as well as telecommunication services to the oil, gas and mining sectors.
The project is unique in several ways. First of all, our international partners, which are Matrix and Fujitsu. With the Matrix acquisition comes the Indonesian licenses and permits, which are very hard to obtain. And so Trident's really already got those in the bag, giving us a strong competitive advantage.
The strength of Trident has been speed, and Fujitsu and Trident together are moving at a rapid pace to mobilise the project into environmental planning, route surveys, marine studies. And this is the value of the partnership.
I think it's a great opportunity for Trident, for Fujitsu, for Western Australia and for Australia overall. It's a great program of work.
Trident, now connecting with business.
In the fast-paced world of communications, there is uncertainty. How do I connect safely to the cloud? How do I protect my data from an attack? TW Telecom has the answers. As a leader in delivering business Ethernet, our network connections are secure, scalable, and predictable. Our resilient Ethernet and innovative services deliver faster, better, and easier solutions for you. TW Telecom, moving your business forward.
Joe Weinman, Senior Vice President from Telex, will engage us in a keynote discussion about the next steps for the cloud.
Thanks for hanging in for us. We've got our last keynote coming up. I've been asked to introduce Joe Weinman, who will be presenting on next steps for the cloud. It was suggested backstage that Joe doesn't actually need any introduction. I think everybody knows Joe, but I'm going to go ahead and give it a shot. Joe has 30 years of experience in executive leadership with companies as varied as Bell Labs, AT&T, HP, and most recently Telex. He's a telecom visionary and a cloud expert. He has 18 U.S. patents, including patents on line coding, simulation, wireless technology, telecommunications, and distributed computing. He has more pending in cloud computing and internet search ranking algorithms, to name a few. He's currently the chair of the IEEE Intercloud Testbed on the Executive Committee, and he's the author of Cloudonomics. This is a book on the business value of cloud computing. It was published in 2012, and it made some bold predictions about the trending for cloud and cloud computing and how that can derive business value and economic value for the companies that adopt it. So here to talk about where the cloud is going next and what we can expect, please welcome Joe Weinman.
That was my short intro. Great, thank you. All right, hi everyone. I don't think I have time left now. So what I want to do is talk about something that I think is maybe the most important thing that I can share with you on the future of computing. And you know, when we think of when we think about all these things is kind of if only we had been around on the ground floor of the internet and could have envisioned things like Facebook and Snapchat and all of that stuff. And I think there really is another opportunity now, and it's this opportunity for the intercloud. And so I'm going to talk about some thoughts there. Before we start, I'm here courtesy of Telex. For those of you who don't know, it's a nationwide provider of data center co-location and carrier-neutral interconnection capabilities. So hopefully you'll patronize Telex. What I want to talk about is some thoughts on the intercloud. And I'm going to begin with some quantitative analysis from my book Cloudonomics and use some of the conclusions that one can derive from there to help better understand exactly how things are likely to unfold in the cloud. I use a definition that I came up with that some people call a retronym, which is cloud as an acronym. And briefly, the idea is that it's a common location-independent online utility available on demand, and common in the sense of shared resources that are pooled and accessible by multiple customers. Location independent, it shouldn't matter where you are or where the cloud service is provided from, as long as response time objectives are met. It's online in the sense that the network is critical to achieving both of those. It's a utility, what we might call a linear tariff, measured service, or pay-per-use pricing model, and it's on demand. In other words, regardless of the requirements that you have as far as capacity, the cloud elastically scales to be sufficiently available to meet your requirements. As you know, hopefully, cloud is not a new business model per se. Instead, you've got things like taxi cabs or pay-per-use and hopefully available on demand. Hotels allocate pooled capacity to multiple customers. This week we have PTC at the Hilton Hawaiian Village. Next week there'll be some other convention in town. And of course, individuals are being stat-muxed into rooms. And the same business model arises in other unusual areas. For example, banks make money off of a shared pool of capital. Instead of pay-per-use, they call it an interest rate. So it's a pretty proven model. So there's no question that the cloud is here to stay. Now, besides being a clever acronym, there are actually some in-depth quantitative analyses I've done around some of the characteristics of the cloud. I'm going to cover a couple of them because I want to use that to then draw some implications as far as what we can expect in terms of cloud performance. But hopefully you've memorized all the equations, including the double angle trig formula for service node distribution on a sphere like the planet Earth. I know it's such a great way to close out the conference with some exciting trigonometric formula. What could be better than that? So first thing I want to cover is stat-muxing effects from independent workloads. Whenever you have multiple customers that have variable demand, as long as those are uncorrelated, the point would be that, let's say we had one customer, as shown here, with pretty dispersed demand, in this case modeled as a uniform distribution. If we take 4 of those customers and then we normalize it, you see that that spread or variance gets compressed, and as we keep multiplexing more and more, you end up with some pretty good smoothing overall of the aggregation, right? So my own use of Hilton Hawaiian Village is 4 days on and then 361 days off until the next PTC, which is January 18th through 21st of 2015. So mark your calendars down for that. That's a very irregular demand, and yet the Hilton Hawaiian Village, through a variety of mechanisms, including stat-muxing and dynamic pricing, yield management, manages to maintain pretty good room utilization. So the important point about this is that if you take a look at this function, it turns out to be 1 over the square root of n, which has a very interesting characteristic to it. Among other things, it says that with only 2 workloads, you can get a 30% reduction in a penalty function associated with either under or over utilization of resources. The key thing that it says is that even mid-sized providers can achieve great stat-muxing benefits. And actually, with only 100 independent workloads, you can get to within 10% of the theoretical maximum perfect cost reduction that's associated with an infinite number of workloads. And ultimately, that means that people talk about the notion that there's only going to be 5 cloud providers in the world. I think that partly what this economic analysis tells you, as well as you can go into other factors that I don't have time for, like countries having their own national self-interest in promulgating their own local cloud providers, the same way that they have, for example, their own airlines, their own telcos, their own power companies, and so forth. So for that reason, I think that there's going to be this long tail of cloud providers, which in turn says that interoperability between all those cloud providers will be absolutely essential. Second key analysis that I want to go through quickly is cloud cost structures, where yes, there are certainly economies of scale that arise. There are also scale invariant costs. There are some diseconomies of scale. But the big killer for service providers is the notion that they have sales, general, and administrative costs, which tend to increase their overall price relative to a well-run enterprise's cost center structure. And so what that implies is that hybrids are optimal. Here's the math. Now that you've memorized the math, I'll just cover the English really quickly. And the English is that all other things being equal, network costs, security, ability to meet the application requirements of the workload, et cetera, if cloud services cost less than do-it-yourself, then certainly you should use them. Perhaps counterintuitively, if cloud services cost more, then don't jump to conclusions, because it still makes sense to use them. And that's because it's not the unit cost that matters, it's the pay-per-use model of cloud pricing. And so you can also prove, using a nifty little bit of calculus, that hybrids are always optimal in the presence of a continuously varying demand curve. Now, what that means is that hybrids are optimal. They're also useful when we think about political implications, running your own data center, inertia effects, migration costs, and so forth. But the important notion here is that there's actually a broad spectrum of hybrids. And it's everything from your own legacy systems, virtualized capabilities that are still running in silos, true private clouds running behind the firewall in your own data center, using your own capital resources on an acquisition model, but all the way through colo with specialized equipment, and/or colo plus hosted private clouds, plus virtual private clouds, all the way through to public. And to make that even worse, there's actually all these different standards and stacks and APIs and interfaces. So picture a lot of these deployment models, some of which are available on various stacks, some of which aren't. So, Eucalyptus at least matches part of the AWS stack, but not the full API and not the full suite of services. OpenStack has implementations with things like the HP public cloud, as well as the Rackspace cloud, and so forth. There are going to be different variations of all of those. And the point of this slide is, if you were to actually put on thousands of little clouds, right, that are all of these other variations, you quickly end up with a Tower of Babel, aka complexity that then increases the friction of deployment, limits consumer choice, and makes things very painful. Instead of this, what we'd like is a single intercloud that spans everything, the same way that today we don't worry about private proprietary network stacks like Novell NetWare and so forth. We just have an internet that ties everything together into a clean bundle. It's a utility service. It's got perhaps near infinite capacity. So the originators of this concept, David Bernstein and Steve Diamond, are in the audience, so you can chat with them later if you'd like. But the basic point is that what we'd really like is, in effect, the essentially infinite capacity of all of the computing capabilities on the planet to be seamlessly, transparently available with full convenience, ease of use, and kind of moving to a don't care model where everything just works together. Now, to make some of that happen, I think the best analogy that one could consider is what the airlines have done. And when we think about what the airlines have done, sure, there's lots of providers, right? You've got United and Dragon and, well, Sabina is gone, thank the Lord. But in any event, you have thousands of airlines, and yet they mostly manage to do things like hand baggage off to each other. They've got uniform naming conventions for airline codes and airport codes. They've solved the basics of communication. For better or worse, English is the standard for air traffic control to talk to planes. They have the Alpha Bravo Charlie type of encoding capability. So all of those things together really create an essentially seamless global set of airlines where rather than having to restrict yourself to only flying to those places where Southwest flies to, you can basically fly anywhere in the world, have baggage handed off between those airlines and so forth. So in the same way, that then gives you a sense of what's required for the intercloud. First of all, as a basic choice of strategy, this IEEE P2302 intercloud standard and the test bed which will test it is, we think, a better approach than another one which is called the multi-cloud approach. And the multi-cloud approach is like carrying all those little different adapters for power outlets in whatever countries you go to. First of all, you've got to handle the different plugs. Thank God there's only maybe 6 or 7 different power outlet standards. With the cloud, there's thousands, so carrying 1,000 adapters and needing to use each of them in turn and hope your application works would be inconvenient. Secondly, the core ability for communications, the same way that tower communications is in English, being able to let clouds identify themselves, authenticate on a trusted basis who they really are, and then being able to message each other, things like I have resources are available that you can use. So all that identification, authentication, both for service providers and for users, payment mechanisms, being able to leverage the resource description framework to say, I've got 5 virtual machines that are available in 1 hour at this price with this kind of configuration, this kind of I/O bandwidth, and so forth. The ability to have catalogs of services, whether it's compute, storage, or higher layer platform capabilities like credit card validation or message queuing or what have you. Exchanges and gateways to help all of this stuff work together, kind of like air traffic control and baggage handoff. And then also, of course, the ability to migrate applications and the data that they require around from cloud to cloud, and the ability to federate distributed resources accordingly. So if we can pull this off, what it means is that we'll be able to have service providers or users acquire resources from each other. We'll be able to let them sell off unused resources, the same way that airlines have dynamic pricing and yield management. The ability to create markets with different cloud providers and users participating thereby. Reducing user lock-in. And, one could view this as, well, wait, having greater consumer choice might be bad if you're a service provider, but the truth is that one of the big barriers to cloud adoption is fear of lock-in. And so eliminating that fear, right, if you love something, set it free, really means then that users will be less scared of moving to a cloud, and also you won't have issues like the recent Nirvanix bankruptcy, where all of a sudden everyone had less than 2 weeks to scramble or their data was gone forever. So we think that will help accelerate cloud adoption, which is great. The other opportunity, which is kind of interesting, is cost optimization through cloud marketplaces. Faye, who introduced me earlier, is with Zimmery, which is one of these emerging cloud markets, and they're working with the Deutsche Börse to be able to have true derivatives and futures and commodities kind of market. If you can do it for orange juice and you can do it for pork bellies, why not for cloud services? And then also, we expect a better customer and user experience. And think about, for example, the notion, one that David Bernstein likes to use is the notion of federated multi-point video conferencing, where you've got different users on different devices with different service providers, and yet transcoding, migrating content to the edge, and maybe doing sort of augmented reality and overlaying that in with live video streams, being able to have that all happen seamlessly, the same way that you can do international direct dialing is part of what this model is intended to solve. One of the things I want to cover, just to give you an example of quantitative analysis around this, is the quantitative value inherent in cloud marketplaces. And some people have said, oh no, cloud markets can't happen. And there are several arguments that they present. One of which is, because cloud services are so diverse, it's very difficult to create a market, right? We know what number 2 corn is, we know what a gallon of frozen orange juice concentrate looks like, but what is one person's virtual server, virtual machine, bare metal, or what have you? Well, the fact is you can still have a market with diverse capabilities, and I think eBay and Amazon.com are good examples of that. Moreover, there are companies like 6Fusion that are working on normalization of cloud resources through something, in 6Fusion's case, they call it the workload allocation cube, which is sort of an open standard way of normalizing and, in effect, commoditizing these resources. The second thing is, if customers can buy directly, why would they want to go through a market channel? And of course, people use markets all the time. Sure, you can buy from United or American, but most people go to Travelocity or Hotels.com. And then the third thing I want to cover is data gravity effects in terms of multiple providers. This is a simulation that I did and also quantitative analysis using the theory of order statistics. And briefly, what it says is that what you can do in a market is, as the number of participants increases, if they are all doing dynamic pricing, then you can kind of arbitrage across them and end up with this kind of cost reduction. It doesn't require that many players to have this kind of benefit in terms of the market. The last point is that if you leverage things like Colo and AWS Direct Connect, you actually can have the data present with multiple providers, and I call that the food court principle. Once you've driven to the mall and handled all of that transaction costs, then you have your choice of multiple providers: Sbarro, Nathan's Hot Dogs, McDonald's, and what have you. So with that, we have no time for questions. My time is up. I'll just say, if you are interested in the intercloud, please just Google IEEE intercloud or go to cloudcomputing.ieee.org, and you'll be able to join us in what promises to be the next wave of computing. All right, this ends the conference. There is lunch being served right next door as soon as I finally end my long-winded remarks. So thank you for making PTC'14 a success, and we hope to see you next year at PTC'15. Thank you very much.
PTC'14 is made possible in part by the generosity of the PTC'14 sponsors. Mahalo to each of the PTC'14 bronze sponsors. Thank you for all of your support.
One more time. Aloha. Yes, I love it. Good afternoon. Welcome to the closing luncheon and awards ceremony. Although all of the conference is a good experience and a productive experience and a useful experience, I find this lunch to be the most happy experience. We have had, I hope, a very satisfying conference for everyone. And now we come to the awards part of things, where we recognize the achievements of our members and our participants. And so we will have sort of a brief program. We are honored to host the Atlantic ACM Awards. We will then have a brief announcement. I think we will move into the awards for the best research papers, both student papers and general papers. We will then, I think, move on to the presentation of the Richard Barber Award. So we have, I hope you all enjoy your lunch and should continue enjoying it. And we will move along as best we can with the proceedings as I described. And I thank you very much. Welcome. Enjoy.
Thank you all very much, and thank you for coming to these awards and for coming to PTC. I hope it's been a great experience for everyone. I'm joined by Aaron Blazer, our Vice President, and we are here to present the 2014 Atlantic ACM Global Wholesale Report Card Best in Class Awards. Atlantic ACM is a telecom-specific research firm, and every year we do a number of research studies where we reach out to customers and ask them to review the carriers with whom they work in a number of different categories. Do we have a presentation slide we can pull up? Thank you. So we do this in domestic U.S. long-haul wholesale, metro wholesale in the U.S., global wholesale, and then also one for business services, so we can help carriers better understand how they're doing relative to the market. We are here to talk about the global wholesale, which, get the next slide, please, which we distribute to countless wholesale buyers, and in return this year we had almost 400 customers provide 1,500 carrier reviews. And the awards that are about to be presented are based on that explicit feedback from customers, so completely impartial and completely driven by the actual experience. We'll be presenting awards for brand, sales reps, provisioning, network performance, billing, and customer service. And we do this in two categories. One is large carriers, which are carriers with $15 billion or more in wireline revenue annually, and mid-size and under, which are the smaller ones. So without further ado, we'll start with the large carriers. The first winner is BT, who received the Large Service Provider Award for Network Performance. And we have Alex LaRue here to pick up that award, the Director of BT Global Telecom Markets, Asia Pac. It's a big auditorium, takes a little while. Up next, we have the next winner, which is Deutsche Telekom, who has won 2 awards, the award for network performance and the award for billing. Obviously, network performance is about the most important thing out there, so that's a very prestigious award, which was shared in a tie with another carrier. Jonathan Webster, unfortunately, couldn't be here, but we have Corinne Haley, the Director of Marketing, here to accept on behalf of DT. Up next, we have another large carrier. This next award is going to Orange, who has won for brand. It is recognized as the leader in global brand for wholesale, a very impressive feat. And we have Isabelle Laurent here to pick up that award for Orange. We're making this challenging for people. The last award recipient in the large carrier group, hey, Isabel, is receiving 3 awards, sales reps, provisioning, and customer service. And those 3 are going to Telecom Italia Sparkle, who always does extremely well in this study. And I believe we should have Dino Civitarse here to accept those awards on behalf of Telecom Italia. We do. Congratulations. Moving on to the small carriers. We have 2 small carriers who in this case have taken home all 6 of the awards. The first winner is Bix, who has won brand, sales reps, and network performance. And we have Nicholas Nikruyan here, the Chief Commercial Officer, to accept that award on behalf of Bix. Congratulations, Nicholas. Thank you. And last but certainly not least, we have another recipient from the midsize and under category taking home provisioning, billing, and customer service, and that is iBasis. And we are pleased to have Catherine Doe here to accept the award on behalf of iBasis. Next year, maybe we should everybody line up next to the stage. So I'd like to stop and recognize all of our winners. Congratulations to you all. It comes from your customers, and please continue the great service you're providing.
Thank you very much.
Thank you all very much, and enjoy your lunch.
Thank you.
Like Richard Barber, like Richard Taylor, this is the last aloha you're going to hear from me for 1 year. So aloha. Thank you. At this time, I'd like to ask Richard Taylor to come up here to the stand and podium, please. We'd like to, on behalf of PTC, we'd like to thank Richard and offer him many deep, sincere, heartfelt thanks for the service that he has provided to PTC for the year 2012 and 2013 as our PTC president and chairman of the Board of Governors. He has done a wonderful job. You can see the transformation that we are slowly having throughout the years, or the last 2 years, with Richard at the helm. So, thank you, Richard.
Thank you.
Okay. Now,
So
should
I
I?
think it says I'm going to introduce.
I'll stand on the side.
Thank you, Sharon, very much. You might wonder why I'm getting a present, because we're in a transition mode here. As Sharon said, I have had the privilege of serving the members as chairman and president of the board for the last 2 years. The board are all volunteers. They all work very hard. I would like to acknowledge the fine work that they do and the great support I've gotten from them as chairman. And it would be impossible to overstate the support that I have gotten from Sharon and the Secretariat, which has just been absolutely fantastic. But it is the nature of the process at PTC that things move along and we rotate positions. So I will be no longer president and chairman of the board, and it's my privilege to introduce to you the 2014 president and chairman of the board, who will be Stephen Ho, president, CEO of CITIC Telecom in Hong Kong and other places. And Stephen has served the last 2 years as vice chair and has been an enormous and able supporter of the work of the chair and the board and of PTC in general. So it's my great pleasure to turn things over to Stephen Ho.
Well, in line with the tradition, this is what I'm going to say first. Aloha. I am very honored and very privileged to have the opportunity to serve the board at the PTC. And I'm a passionate person, so right now I don't know what to say. But I have been asked to say that I've got 20 minutes of my time here. So everybody, you have to be very careful because otherwise you get bored and asleep, and then we don't have our board meeting later on. Hawaii is a dream place for me. It was a dream place for me, especially when I was young, because when I was in Hong Kong, and I'm a person that was born and raised in Hong Kong, and we saw this television, black and white, when I was a kid. And I would say to my mom and my dad, and I said, what is this little girl, doing this Hawaiian dance, right? And I want to be there, right? And of course, that is really at the time beyond our means, and, there's only a dream for me. And, you never know. I mean, dreams comes true. And this is really a moment that, to me, is really, really sensational as well as emotional, because not only did I get the chance to visit Hawaii and participate in such a great conference, as well as meeting all these people, I'm also have this particular opportunity to work with colleagues here at the board, and very honored and very privileged to be the chair this year. And I have to thank Richard for his guidance over the years that I've been at the board, and of course Sharon and her secretary, which has been wonderful and great. What is not very good for me now is because Richard has set such a high standard. I mean, he has raised the bar so much that I'm now having a tremendous burden to think about, what will happen in 2015. But what I can say to all of you is I will make a pledge that I will have the best of my ability to work along with the Board of Governors and the Secretariat and Sharon and all of you, especially all of you, because you are very, very important people. You are the members of PTC, and this is really your conference. This PTC is much about you. I'll work with all of you, and hopefully, having our plans for the 2015 and have the next very successful conference as well. So thank you very much.
Hi there. I'd like to introduce, we have paper award winners as well as the young scholars. So I think first of all, we'll maybe start off with our student paper award winner. And I'd like to acknowledge Betsy and her son Alex, Bronstein, who are here today. And Betsy and her husband Yale, of course, established this award in the honor of Yale's father, Oscar. And this award is it's for the best student paper entry at PTC 2014. And this year's award winner is Rishabh Dara, doctoral student, coming up here, from IIM Ahmedabad in India. And the name of his paper is Policy Instruments for Green Telecom. So congratulations, Rishabh. Thank you. Congratulations. Next, we will introduce the winner of the research paper, and this is the Mihiru Jiswala. Many of you knew Mihiru, a longtime contributor and shaper of PTC's research and PTC in general. The winner this year is Laura Hossman with her co-author, Laura Army. So why don't you come up, Laura? The title of Laura's paper was The Centrality of Electricity for Internet Uptake in Low-Income Countries. And congratulations. And Laura's from USC, yeah, and currently at ITT in Chicago. Okay, then our third set of research award winners are this year's Young Scholars, and we have a great group of 7 students and 1 postdoctoral student who's actually just finished and is now working at the European Commission. Why don't you guys come on up? And we'd like to thank the PTC for supporting the development of this program. This is the 2nd year, and we have a really accomplished group of students, and the papers were fantastic, and this year they presented in the sessions, so thanks for giving them the opportunity to be here. They've all expressed their gratitude and the fact that they've really gained a lot from this experience, and I think they've also helped contribute to the program, and hopefully in the coming years will bring more students like themselves to the conference. Okay, so let's see here. First of all, where's Ibrahim? Okay, we'll start off with Ibrahim Rahman. The title of his paper is Decompression Analysis of the Telecom Sector in Indonesia, and he works now at the European Commission Joint Research Center, and he got his doctorate recently at Chalmers University of Technology. So congratulations, Ibrahim. Do you want to go right one? Okay, next up we have Germain Gaudin. My French accent was good enough here. Germain is a postdoctoral researcher at the Düsseldorf Institute for Competitive Economics, DICE, and the title of his paper was The Interplay Between Price Squeeze and Access Regulation. Okay, next up we have Farhan Misra, PhD candidate from the University of Auckland in New Zealand. And the title of his paper is Using Agent-Based Approaches for the Analysis of Competitive Dynamics in a Mobile Service Market. So congratulations. Next up, we have Shalita Srinanan, currently a lecturer at King Mongkut's Institute of Technology in Thailand. Got her PhD also at Chalmers Institute of Technology in Sweden. And the title of Shalita's paper is The Uncertainty of Public Payphones in Thailand. So, congratulations. Okay, next. Next we have Bing Chen Day, research scientist at the Singapore Management University in Singapore. And the title of his paper is How Can Consumer Preferences Be Leveraged for Upselling Cable TV Services? So congratulations. Okay, next we have Alec Mehta from USC, doctoral student, and the title of his paper is Estimating the Value of Mobile Spectrum. Okay, congratulations. Okay. And then last but not least, we have Sarah O., a PhD student in economics from George Mason University in Virginia. And the title of Sarah's paper was Accelerating Radio Replacement in Spectrum Policy. So, congratulations. Okay, so it's a great group, and hope you have time to take a look at their papers, or at least the presentations. Thank you. Yeah. You want me to? Okay, thanks.
We're getting near the end, but once more, aloha. I am very pleased to be here this afternoon to announce the winner of PTC's 2014 Richard J. Barber Award. This award recognizes those who have provided exceptional service to PTC over a significant period of time. It is named in honor of our founding executive director, Richard J. Barber. To help me with the presentation, I'm going to invite our current president, Stephen Ho, and ask him if he could join me here on the stage. Thank you, Stephen. From a very strong set of nominees this year, our committee's unanimous choice is an individual known to all PTC regulars. She and her team have delivered and supported great programs and great conferences year after year, and have done so, as one of our committee members observed, I shouldn't name her, but I will, it was Faye Harris, said that she does all this while managing all those egos. Now, who could she possibly have had in mind? In any event, with a little extra assistance, it is my great pleasure to welcome to the stage this year's winner, Sharon Nakama. Sharon, please join us.
Thank you very much, Bruce, Stephen, and for those whoever it is that nominated me and those who had selected me. Okay, I'm not going to get emotional, but here, I just thought of something. For those of you who don't know, my nickname, and whoever knows me, they call me Pooh. Okay, and I've collected Pooh Bears since I was a very little girl, so I'm known as Pooh Head, Pooh, Auntie Pooh, Cousin Pooh, all kinds of Pooh. And I just figured out what I'm going to name this Pooh. His name is going to be Pooh. His name is going to be PTC. Okay. Just a few brief words. I am very deeply honored and touched to receive this award today. I've been with PTC for 2 decades and a half. So I've been around a long time, and it has been my privilege to work with Richard J. Barber. He is one of my very first mentors, especially in the business world. You know, he has taught me quite a lot, and I have carried that throughout many of the years, so I really do owe quite a bit to him. At PTC, we don't do a lot of the technology and groundbreaking things that all of you do in the world, okay, with technology, with anything dealing with telecommunications. But what I have realized over the years is that we help to bring a community together, which is more important to me than many other things that happen in this world. This community that we have with PTC is made up of volunteers. And I'm not going to ask you all to stand, but By the raise of hand, I want to know how many of you have either done a paper, been a BG, been an AC, been on a committee. Can you just raise your hands? You know, who have, let me see, who have been media for us. I'm looking at some people over there. But if you look around, you will see that all of these folks who have been volunteers do it on their own time. They have full-time jobs which are very much extended past 8 hours, but they put in a lot of time to PTC. And I want to thank you, because without you, we would have no PTC. Then the last thing, whoops. The other thing, or the last thing is, I want to thank the PTC team back there. Thank you, because without you and your support, I wouldn't be here, and also there would be no PTC. So thank you very much. I'm deeply touched, and again, aloha.
This truly is a game changer in the industry. We're changing the way business is currently being done. We, as Digital Realty, are the only data center provider out there that can do this. And the internet community is excited about this. Digital Realty Open Internet Exchange is an environment that we've created within our data centers. We, as a data center provider, will just give them the environment, and we let the community itself operate the exchange. We are giving the internet community something they've been waiting for, and that is an environment that allows them to provide a better product with significantly lower costs. The current internet exchanges are run in a much more controlled manner. This has created the limitations that the internet community is facing and have become very frustrated with. If the exchanges are in our facilities, customers need to be in our facilities. Connectivity is the key component for data to get from point A to point B. Data comes into a data center to be stored, to be secured, and to be sent somewhere. The connectivity initiative is we're tying all of our data centers together and extending them into the current exchange points. This then creates the ability to get the traffic that's required from our customers and to our customers over our ecosystem. We are creating a new environment, a better environment. Our customers are going to want to do business with us for simply the ease of doing business with us, the strength of the company, the quality of product that we deliver, and the environment that exists within our data centers.
Thanks for joining us at PTC'14. We hope you enjoyed the conference, and we look forward to welcoming you back to Honolulu for PTC'15 from the 18th through the 21st of January 2015. Aloha. PTC TV is brought to you by PTC'14 Platinum sponsor Equinix. Mahalo Equinix. Thank you for sponsoring PTC TV.